All right, so I'm back from what's one of the most beautiful parts of our country. If you haven't been to Montana or to Glacier National Park or anywhere in that area, we spent the holiday weekend climbing the mountains and hiking the trails there in Glacier National Park. Hiked a 13-mile long trail, the Highline Trail there, with just amazing, amazing views, face-to-face interactions practically with mountain goats and bighorn sheep and marmots and ground squirrels, everything but bears, which was perfectly fine for me, considering we had the whole family with us. Still feeling the effects of walking a half marathon at the top of the world, practically here. But glad to be back with you, and the markets kind of seem to still be on vacation themselves, despite hitting all-time highs while I was gone. So I'm going to break down this market and break down the trend that we're on right now, and are we getting enough of a pullback here to suggest that this intermediate run may be closer to ending, and then how can we balance out what has been a pretty heavily bullish trading activity lately in these videos with something on the other side. So let's find an opportunity there. So as always, let's go ahead and get started. Today is Monday, July the 8th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the Market Forecast Indicator, like we always do. You can see that we are in the midst of a two-day decline, a near-term pullback, which hasn't quite started yet, because even though the near-term line is dropping, it's not below 50. That's when you've had a near-term pullback. We are obviously getting closer and closer to that point, trading with an inside day today inside the lower end of Friday's range there, after Friday rallying up to the close by the end of the day. So kind of retesting the lower end of the early Friday's range. Despite that, the posture, the green line you see, is well above 80. So the posture remains strongly bullish, despite the pullback. Despite, and it's interesting how you get, a couple of days declines, and recession calls and discussions of bear markets all come into play. And the reality is, we are just that far away from all-time highs, nearly touching 3,000 last week. We're not that far below it. I got this on a percentage basis here. There we go. Not that we're only 20 points below the all-time highs. And the trend is strongly bullish. You see dark green shading and dark green line. That's as bullish of a combination that you could possibly get. Yes, we are pulling back in the short term, but you can see during this intermediate run we've had one near-term peak, two near-term peaks, three near-term peaks. So you come up here and you look for the corresponding highs in the S&P. Here's the first one, here's the second one, and now the third one. You see they're all higher. We've had, one, two, and this would be the third near-term pullback during this intermediate run. And every time it's pulled back here to here to here, it's also been to higher lows. So as much as it doesn't seem to be that way when you listen to a lot of media or follow people on Twitter or whatever the case is, trend. The definition of a trend is higher highs and higher lows, right? Which means a bullish trend has to have pullbacks. Otherwise, it's not a trend. It's just one big upward move, but not a trend, right? And so, as of right now, you can see these near-term pullbacks are creating a bullish intermediate trend, a bullish posture, and again, it's okay to have 2 days, and even in this case, 4-day pullbacks, especially when the declines basically come down to the old near-term highs, right? You see this near-term high acted as a support. After we went to new higher highs, it came back, and the old high acted as support. You went to new highs here, and as you pull back, the old high so far is acting as support, which also happens to be the old high from May. So we'll see if that continues to be the case. As always, the Dow looks very similar to the S&P 500. The NASDAQ is giving us a intermediate confirmation signal, has not quite broken through those highs from May here, so quite looking to really break through. And of course the Russell 2000, it also, even with the pullback and the relative weakness the Russell's had, unable to really get going still has a bullish combination of dark green shading and dark green line, right? And of course it'll be more bullish if you were to break through these early June highs. And of course, you can see it's been so long. It's been unable to really get going all year long, where the S&P 500 is easily above these August highs, and for that matter, the S&P 500. Here we go. There's the January highs and then the August highs. That's the Russell 2000, and you look at the S&P 500, and we're easily above those August highs, September high point there, and obviously easily above the January high too. So that's the big difference in the S&P and the Russell. The S&P is actually still below those old January high points, which happens to be the peak from May that we have to break through before you really can say small caps are in a bullish trend. All right, before we look at some other charts, I want to invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also a red subscribe button down below the video. By subscribing to our channel, that will notify you when these videos are posted. Also, hit that thumbs up icon down below the video. That tells me two things. Number one, you like the video, or you got something out of it. Number two, it's a way to tell us through your feedback that you want us to do the video again tomorrow. So it's a quick way to give us feedback. One click you can do right now while you're watching the video. Also, while you're down there, comment on what you did get out of the video. So that way people who come to the video for the first time can see why they should check it out themselves. As always, join our Market Outlook email list, our daily email list that we have. There's a link popping out in the top right corner of your screen. Click on that link up there to subscribe to our list. Follow me on Twitter for more content in between videos from day to day, and join our Market Outlook community that we've created on Facebook. We also invite you to come over to our website at marketscholars.com and subscribe for free to our website. You can do that if you're watching our video on our blog here. There's a image up here in the top right corner under Join Market Scholars. Click on that image. It takes you to our subscribe page where you can do it for free. Like I said, that allows you to participate in our community that we have on our site, Market Outlook Forum. Specifically, our class forums are for our premium clients and students that go to our classes. You can see our calendar of classes over here on the right. This view more will take you to our full calendar. We also ask that you engage with us on social media. That way Twitter and Facebook knows that you want them to show you our stuff that we put out on Twitter and on Facebook. And so we try to make it really easy for you to do that. All you have to do is click this heart that likes to and like this, hit this like button. That will like today's Market Outlook tweet. For those of you that have Twitter accounts, and of course you can also click this image, takes you to your Facebook page where you can like today's Market Outlook Facebook post there. Facebook is really notorious for not showing you everything from Facebook pages, and so you really have to engage with that page. The more you engage with it, the more they know that you're pretty serious about wanting to see that stuff. And so like I said, Twitter and Facebook, we try to make it easier for you by being able to engage right here, straight from this page. You can do right now, like I said, while you're watching the video. All right, now let's take a look at the long-term chart, and you can see it continues to be bullish, even with yesterday or last week's 3.5-day week. Smaller range, but up to new highs. You can see how it kind of broke out there, and so far this week's very, very small range. And and the importance this week, of course, is staying above this 29.45 level. And we're 30 points above that right now, and getting to that avoids a long lower shadow. That's kind of priority number one for those of because we are bullish, right? You're looking for signs to stay bullish or signs that we might be turning bearish. So the kind of that first sign is to avoid that lower shadow, and the second sign, which is not as necessary, is to get a higher upper shadow. So it'd have to be above 29.95, and of course we're only 20 points away from that. So we're actually closer to getting a higher upper shadow than we are to get any lower shadow. So you can kind of see that's a good sign. From a Heikin-Ashi standpoint, it's a good sign to maintain the bullish trend that, again, you expect to last 1 to 3 months. And so far we are this would be the 5th week into that, or excuse me, 1 to 3 months would be 4 to 13 weeks on this, on a weekly chart, and we're so far into week number 5 on that trend. Let's take a look at the 3 green arrow chart. And you can see we're getting 3 green arrows as of right now, so that's good. From a bullish standpoint, 3 green arrows and a green line. You can't be more bullish than that. If you look at the 2-line versions of both those charts, you can see the MACD has had its surge, that initial surge now, and it doesn't really V top usually and break down hard below zero. It usually grinds its way towards zero, kind of like that. But it probably won't be as long this go around, probably more like this as it grinds its way towards zero. And you can see the stochastics is also diverging with lower highs here. So a little bit of short-term weakness, but still, even despite that 2-day decline and all the recession calls that I just hear like literally nonstop today. I don't know if it's just the the theme of the day, but we're trading above the 8-day exponential moving average still, despite the decline. So, and the 8 and the 17 are both rising. They're well above the 30, which is also rising. Again, it's kind of hard to be too bearish in that bullish environment. Now let's take a look at the intraday chart, and you can see, okay, again, let's go back to the Hakinyashi and update that. So it's the weekly here, and pull up SPY, and pull up the Hakinyashi here, and you can see the open for this week's candle is 294.03. So let's go back here, and we'll change this to 294.03. 294.03. There we go. So there's the open, right? We have to stay above that. Now, I told you before last week that this low point's really going to move up pretty quick. So unless we bust out to new highs, which we did, right? So we did get up to 298. We were at 296. That would have given us an 11-point range. Just as a reminder of how much that's moved up, right? So we've moved that in the last 3 days. That's how much it's moved up. That 4-week range here. So it's really tightened up, and it's going to tighten up some more over the next few days, right? Because it's going to eventually get up here to about 287, and again, that would be about an 11-point 4-week range, unless we push up to new highs. And the 5% mark, when you're pushing up, when you're looking for a kind of blow off top type pattern, you're looking for a 4-week range that gets to extended beyond that 5% mark. To the downside, it's 10% when you're on a bearish move. So, obviously 5% of 29.88 or 299, 10% would be almost 30 points. So, 5% would be 15 points. And so the range right now is at about, 15 points, 298.82 to 282.57. It's about a 5-point range. But like I said, that's going to change here pretty dramatically in the next 1 day. After this day comes off, then we'll move up to 287 just like that. So we'll move up 2 points. It's actually 285. Sorry, 285.74 to 298. So you got about a 13-point. So you're just under 5%, and it will be even more under 5%. And by the end of the week, it will move up a little bit more, another point up to 288. So unless we really push up to new highs this week, then we're going to be in a nice, steady, bullish 4-week range, pushing towards the top end. But that's good, right? That's another sign of a bullish move. Obviously not a sign of a bearish move. The sign of a bearish move is when it really tightens up to well less than 5%. When it really tightens up to like this size of a range right here to, like 6 points, out of 296, that'd be about a couple percent. Then that's when you're like worried that we're going to break down to the downside. But as of right now, that's not a concern because we're not tightening up. While we're moving up down here, we're also pushing up here. And that's when you have the low tag on the left-hand side of the chart and the high tag on the right, that's a bullish combination. Let's take a look at the volume in the trading range today. Again, summer day, right? So very, very small volume, only 2 points. And the trading range at, for trading volume at 45 million. I mean, this is like we had a full day on Friday, and Friday's volume was 51. We only had a half day on July 3rd, and we had 41 million shares traded. So we barely had more shares trading today on a full day of trading coming out of a weekend than we had on, Wednesday on a half day of trading. So very, very small range, needless to say, and that's Again, very typical of summer grinds, right? Summer grinds are boring. They don't move very much. Very small ranges. That's why everybody thinks they're so bearish. That's why they're associated, like, there's the expression of climbing a wall of worry, because there's always geopolitical issues. There's always something that says the market shouldn't go up, and the market goes up so slow that it gives you the impression that people just aren't that bullish. And the reality is that's the nature of the summer beast, right? Of the summer grind as you push up. At least recently, of the summer grind. So again, 45 million shares traded, 2 points. Those are both in the very, very end of, the very low end of the 52-week ranges. 45 million shares is actually below the low end of the 52-week range of the average volume. 2 points, and obviously 2 points is well below 1%, which is 2.9 points. So that's bullish, right? That's when you're below this 1% mark. When your ATR stays below that 1% mark, right now it's at 2.62, then that's bullish. That's when you're in a nice. That's when you're solidly entrenched in a bullish trend. And the last thing you really need, and we did actually have some of it last week, is to get below this 90% mark and stay. Now today we bounced back up, so volume kicked up today, and we actually took advantage. I took advantage of that. Those premium clients got the trade alerts for trades I made for our Wednesday class, our options inventory class. We took advantage of that based on what you've learned in that class there. But it didn't pick back up into even the upper half of the neutral range. So that pickup in volatility wasn't necessarily bearish. It's not necessarily bullish either. You get below 90, you want to stay below 90. That's when you're entrenched in this bullish trend. So we're not quite there. We're getting closer, but that you don't get in summer grinds. You don't get very many chances to sell premium on volatility jumps, and today we happen to get one. All right, so before we look at what's driving the markets today and our trade idea, we'll just summarize the technical outlook that we have so far, and that is to say that we are bullish. It's boring. It's grinding. It's not entrenched completely yet with the drop in volatility, but we're getting there. The ranges are small, which is what you expect. We're getting new highs, new near-term highs, higher near-term lows as of right now. All the signs for bullish trends are there, even with the pullbacks that we get. They've been nice, quote-unquote bullish pullbacks, the type of bullish pullbacks, and we happen to be in the midst of one right now. So that being said, that's our outlook. Do you agree or disagree with? And the expectation is after this near-term pullback, we'll bounce and continue to trend on the current strong bullish intermediate trend that we have. So continuing that trend higher. So what do you think? Do you agree or disagree with that outlook? As always, there's a link popping out right there. Click that link. It opens up a poll, and now you can vote. So vote with either agree or disagree. If you disagree with that outlook, comment down below in the comment section on what you're seeing that either makes you more bullish than I am, or that makes you more bearish. Obviously, everybody has their opinions, but would love to see what's driving your opinion. What do you see? What chart you're looking at? What data point are you looking at that tells you, like I said, that either you're more bullish or more bearish than I am. All right, so now let's take a look at what's driving this price action. I kind of want to look at basically since I've been gone, how the markets have moved, and this kind of gives you an idea of the fact that we are in the summer season, right? That it's July 4th, that a lot of people are gone. There's a lot of people up in Montana where we were at. It's just that time of year, right? There's a lot of people I follow on Twitter, financial types, that are also gone on vacation. It's just that time of year, unless you're an NBA analyst with NBA free agency kind of in full bore last week. Everybody else is taking vacation, and you see that reflected here. The only markets really that have had any kind of significant move outside of a tight range around zero over the past week has been emerging markets and crude oil down to the downside. So some weakness there. The gold and the U.S. dollar both had moved up. So the gold started last week, a couple days last week going into the holiday with a good rally to the upside, along with treasury bonds, and the dollar was down. Well, treasuries have held up, but the dollar has then bounced up coming out of the holiday with a really strong bullish jobs report. The dollar really jumped up, and gold held up. Despite the rally in the dollar, gold held up. Of course, the strong dollar pressured emerging markets, so that's why it had the bigger decline. It was already declining going into that. And then, of course, crude oil. Crude oil has been struggling a little bit. If you look at its market forecast chart, you can see, again, it hasn't been able to get that combination, right, of dark green shading with this green line rising. And even with the decline today, the intermediate line actually jumped up, so you have dark green shading there. But if you look at the line, it's still falling by 0.05 of a point from 55.69 to 55.64. So that means it's going to be yellow tomorrow. So we're not quite getting that combination, that bullish pattern. You look at the dollar index, which remember had that big jump with the jobs report on Friday. It's really jumped up, and you notice it's gotten back up to this trend line that was drawn as a potential resistance level. Again, does not have the dark green shading yet because the intermediate line is not above 50, and don't have the dark green line yet either. So it's a strong rally, and really it's a big rally coming off of that 628 low point, where we really jumped up pretty high starting in July. So from 628, it's really kind of made a strong move, and a lot of that is associated with kind of this bottom developing in yields and kind of holding up. Yields are still low. They're barely above 2%, but 2% as of right now, even with the drop on right before the July 4th holiday, below 2% is holding up. So 2%, that mark, with all these clusters, look at all these oversold clusters, dark pink shading, dark red line, bearish trend for yields. But I think right now, because we're so overextended to the downside on yields, when you look at the 10-year note here, or the 10-year chart, see how far down we are below the 200-day moving average. That's pretty far down there. The PPO down there is kind of an apples-to-apples comparison. If you look at how deep we are, there's only been a couple of other times, and one of them is the financial crisis, right? The Lehman Brothers collapse and that fall to December drop in yields, and the other time was the credit crisis. Those are the two other times that yields have been this far below or more below the 200-day moving average. All the other times here in early 2015 and then summer 2016, coming out of Brexit here, you can see what happened after that. They formed low points and rallied when we were this far below the 200-day moving average. So I think we are kind of at that point where we are establishing a low and looking for it to make a move. I don't think we'll trend up to new higher highs here, but I do think we'll make a run back up towards this 2.5% area, maybe down to 2.4 to 2.5, and that zone is where we'll make our run up to the upside. If you look at TLT, as the alternative, which is the ETF that tracks bonds, right? So bond prices. If you look at its volume profile, you can see, you don't have much of a volume. If we were to break down, you can see that until you get down to the actual the value area, that's down to 126.5. There's very, very little support there from a volume standpoint. So it can fall very quickly, which means yields can rise very quickly. So I actually expect that, and that can actually be pretty bullish for the stock market. Again, another sign from an intermarket standpoint to expect risk appetite, right? Selling off of bonds would be a reflection of risk appetite, not necessarily risk aversion. Gold has a similar pattern as yields. You can see it's really kind of gone up, doesn't have a whole lot of volume support until you get down into this 1350 area. So again, with any strength in the dollar, that can put pressure on gold, and that's kind of where your gold's been very overbought, and that's, you got a very high bandwidth. So I think you're just basically consolidating on gold. I do expect the trend on the dollar still to be bearish. We've been in this inflation cycle to the downside, right? With inflation expectations here moving to the downside. You can see this trend since about August, September. You also see that in the economic indicators. A lot of economic indicators have been coming down since right about August. A lot of, especially the year-over-year indicators. We don't have very many major indicators due this week. The FOMC minutes, and then you have Jerome Powell testifying to Congress, to the Senate first. I believe it's the Senate first, and then the House. Yeah, that's usually the case. Yeah, so the Senate first here. Well, actually, the House first, and then the Senate. The House usually is the more comical one to watch because, again, for whatever reason, right? From whatever politics you want to play into that, it usually ends up being the one the senators have been in their places for longer, so they have more experience in dealing with the Fed chairman. So the questions you get out of the House tend to be pretty comical, especially with some of the newbies, first timers. So that being said, but that's all going to be in the news this week. Anything that comes out of that, but no major indicators until we get to the CPI and PPI. Which is coming out at the end of the week. And you can see, the reflection of these year-over-year growth rates and these economic indicators, you can see, what they've all peaked right about here in August, and they've all been declining this is the year-over-year changes. That's a very common pattern across a basket of indicators. That's why this whole surprise index is so bearish right now, not just here, but also globally. So that being said, you've been in this kind of cyclical downturn here of inflation, of crude oil, right? But crude oil had finally bottomed out. Crude oil had finally bottomed out, with its downturn from August. So actually more October, because it kind of peaked later. But it had come down. All these economic indicators, inflation expectations, crude oil had bottomed. It's trying to figure out this new bullish trend. Yields are starting to bottom. Yields have been coming down too. They're trying to find the bottom at 2%. And so because of all that, you've got the Fed saying, okay, well, you've had this big downturn in inflation expectations and yields, and crude oil is a reflection of inflation, of commodity price inflation. And you see, okay, well, that's why the Fed is expecting here in July, or the market's expecting a 100% chance of a rate cut. And then by December to have an 86% chance of a second rate cut by the end of the year. And then you get to April of next year and you say, okay, well, you have a 100% chance of one, a 93% chance of two. But then after that, you only have about a 67% chance of three. So, which is high odds, but it's not 80%. It's not baked in. And that's all the way to next April. So the market's kind of looking like for one, for sure, two, really good chance of two, and then that's it, right? High probability of more, but not, not baked into the cake here. Obviously, a good chance that those probabilities of not getting a third one can rise. So that's what this drop in inflation expectations. These inflation indicators, this inflation cycle has pressured the Fed to lower interest rates, and that could very well increase risk appetite to the point where yields rally again and stocks continue the bullish trend that they're on. From a sector rotation standpoint, again, you look at just how the sectors have performed today, and we'll pull up sectors over here on the right. Real estate, utilities. Again, this drop in this drop in bonds, like a bounce in yields, actually would put pressure on those interest rate sensitive areas. So those are two areas to kind of keep an eye on. They've been relatively bullish. There's the market as a whole. You can see technology, communication services, discretionary, all these cyclical areas really doing well. In fact, pretty much all these areas are doing well except for the one. Energy is still just struggling. It's got the lowest. Its intermediate posture is actually falling. It's bearish. It's weak, but it's bearish. Everything else is strongly bullish. They're all above 80 except for utilities and real estate, which have been lagging behind lately. But they're still rising above 50. So dark green shading, dark green lines, and that's the combination you have on all of these sectors except for the one, which is got this yellow line. Now that yellow line is rising now, so you do have the intermediate line rising. You just had the moving average, rising. You get the intermediate line rising. Now it's got that bullish combination. So it'd be the only one left that doesn't have that. You can see materials, communication services, industrials. So a combination of cyclical factors as well as dollar sensitive factors, with that kind of stronger dollar weighing down on those areas. That have been relatively bullish here lately. In fact, if you look at, again, how things have performed since the last time I did this video, so it'd be July. Let's go down to July the 2nd. Go to about a 10-minute chart here, and you can see, real estate, utilities, staples all have outperformed. Now they've been some of the biggest underperformers lately. So not surprising that they're lagging behind. During this little rally, I guess it'd be off of what? This would be 6.3. So if I were to customize this to June the 3rd from that low point that we had there, right there, and put on, we'll do an hourly chart there. There's your weak, your weaker, real estate and utilities and staples are all been weak, and so they've bounced back up a little bit today. So that's not surprising. Materials has been a big gainer, and technology and discretionary have been big gainers during this rally. Energy has been a big gainer up until this past week during this rally. So they're giving back a little bit, but the trend's not changing. So this sector rotation that we've seen today would just be seen as a kind of a pause, kind of a, again, a chance for higher highs and higher lows to develop on the relative strength chart for these indicators. In this case, for these relative strength for these safe haven areas to produce higher lows and higher highs. Lower highs and lower lows for a bearish trend, because again, you would expect them to continue to underperform while the intermediate posture continues in these cyclical areas to pick the baton back up again and lead the way higher. Okay, for our trade of the day, I did look at some of the old some of the old trades I've shared with you, which are a small portion of the trades that we do in our classes, in my option strategies class, directional option strategies class, that we do here at Market Scholars for premium subscribers. But they've all been bullish. I've noticed the ones I've shared with you, at least, have all been pretty bullish. So we have a pretty bullish delta in our market, in the market outlook portion of our active trading portfolio. So let's do a bearish trade. You can see a stock that's in this kind of in that consumer discretionary mode, obviously, but is not looking so hot, and it's got this nice bearish pattern here, breaking down to the downside today. You got dark pink shading, dark red line, right? That's your bearish pattern from the market forecast. Strong bullish posture, strong bearish, strong short-term sentiment. Then you look at the 3 green arrow charts for Royal Caribbean, and you can see we got 3 red arrows and a spike in volume today as you break down to new lower lows. You look at the volume profile chart. Here we go. Volume profile chart for Royal Caribbean. Again, breaking through this big, this is where we were today. So we are breaking through this big volume node to the downside. Not nearly as much volume down here as what we just worked our way through on this side. So a lot of overhead supply up above where we're at right now. And you look at the DMI for Royal Caribbean, and you've got the bearish pattern of crossing. Well, you already had crossed above 25, and you were already below 20, and you've ADX now looks like it's about to cross above 20 because of this breakout. So we got the potential for a bearish pattern or bearish trend to kind of take off from here, according to what you're seeing. In fact, if you look at the trend strength indicators for Royal Caribbean, you can see, let's go to the daily chart. The weekly chart's got showing noise, but the daily chart is showing that we are now moving towards a pretty moderate bearish trend, with it getting above 65 and almost getting below a -2 on the trend quality indicator. You look at the Ichimoku cloud here. Here we go. We are obviously in a bearish trend. Everything looks bearish here on this chart. The green line is below the blue. We're below both of those lines, or well below both those lines. Like I said, breaking below lows. We do have this earnings coming up here in about a month. So that's something to definitely keep an eye on in terms of risk management, risk event for any potential trades that we look at. Let's finally take a look at the long-term view of Royal Caribbean. You can see we had broken below the 200-day moving average, and today kind of solidifying that breakdown with the death cross looming on the stock. So bearish patterns all around. Of course, we can sell the 115 call, buy the 120. $1.16 is what we look for. It's a relatively wide spread. Obviously, we're getting more than that right now. We're up in the $1.60. So that's more than we need. So what we can do now is say, okay, well let's set a stop limit here at 125. That says I don't want to get into this trade until it goes down further, so a couple more dollars further to really solidify this breakdown. I get the credit I want, which happens to be a lower credit, but that's okay because lower credit actually means higher probability, which is what I'm shooting for when I'm doing a vertical spread. If I wanted the biggest credit, then I would just buy a put, right? If I was really strongly bearish, I would buy a put right now, and I would buy a put if we were in a bearish market and this were a bearish sector. But we saw, this sector is pulling back in the short term. The trend of the market's still strongly bullish, so I don't want to be aggressively bearish and add a lot of bearish delta. It's good to have some, even if you're in a strong bullish market. It's good to have some diversification for risk management's sake, but we don't have to be aggressive. So I'm going to stick with this bearish vertical here and sell the 115 by the 120 and set that stop limit order there, keeping my risk at around $750 and going for a $250 reward. Well, this would be with 2 contracts, so $125 with 5 minus 125, 375 being your maximum loss in that case. Of course, the maximum loss that you would take if you were to analyze this trade, put in the risk profile, we'll put this into a single. If you were to analyze this trade, this would be for August. Let's go to August up here. Remember, there is a risk event before August expiration. So if we can get to, to 62.5 dollars before, great, take it, right? We'll take that gain. We'll take half. See, it's a lot quicker to get half the gain than it is to get the second half, especially if you have an earnings that can impact you in that second half. So if we can get the first half on a directional move to the downside here, great, we'll take that trade and we'll move on. The biggest risk that we'll take to the upside is about $125. So it's kind of up here in this 115, 117 range, 117 and a half range, to kind of show you where that's at here on the chart. The stock would have to get back up above its volume node, the point of control, which is the biggest volume node on the chart. The most volume has on the past year has been at that level. So that's going to act as a really strong resistance level, which is great, right? So it's got to break resistance for you to get out of this trade. As long as it stays below and moves down, that's how we make our money on this. All right, and that wraps us up for today. As always, you've heard from me. Now I want to hear from you. So use that link that goes to our Market Outlook forums on MarketScholars.com. Open up any new thread you want for any questions or comments you have about what we discussed in the video or on anything we didn't discuss in the video that pertains to this topic. And of course, you can reply to anybody else's thread in there as well. Remember, you have to subscribe to our site to participate in those forums, but you can do that for free like I showed you earlier in the video. As always, thank you very, very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow me on Twitter for more content in between videos, and join our community at MarketScholars.com as well as on Facebook. Have a great rest of your evening, everybody, and we'll see you all tomorrow.